Hello, hello, hello. So, the company we are analyzing is Cantabil Retail India. This is a company which manufactures and sells ready-made garments, so ready-made shirts, jeans, um, underwear, I don't know, stuff like that. Yes, so ready-made garments, it's in that industry. And if you're interested in this stock, then, and if you want to know if this is a good investment, well, I can't tell you because I'm not SEBI registered. I'm not a registered financial advisor, and this is not financial advice. But what I can do is give you information which could be a starting point for you. Yes, you, if you're interested in Cantabil Retail as an investment. So, this video can be a starting point for you to further research into this company and then safely decide, okay? Wisely and safely decide whatever you want to do. Of course, it's your choice. Let's start with the analysis. So first, this is screener.com, the website is having all this data on. A very nice website. We have the market cap. Total market cap is 2035 crore rupees. So not the biggest company, not the smallest company, noticeable. The current price of one share is 243 rupees. The book value per share, book value is assets minus liabilities, basically what the business has left after paying off all its loans and all that. So whatever it has left, 47 rupees per share. So current price is way more than book value. Then the dividend yield is a very small 0.4%. Fine. Return equity, very nice and high 20.8%. Solid, very nice. Return on capital employed, 18.2%. Very nice. So ROE, ROCE are two metrics which are very important for measuring the efficiency and profitability of a company, basically. So we just saw the size. Let's see the profit and loss over a long period of time. Because, of course, in business, sometimes stuff happens which are out of our control and they can affect revenues, profitability for 2 to 3 years. So we should see a longer term perspective, basically. So these figures are all in crores. Here we have sales, expenses, operating profit, even the operating profit margin. We have interest, we have profit before tax, and after all that, we have net profit or profit after tax from 2014 all the way to 2025. So 2014, and this is the sales growth, of course, below the sales number, 100 crores in revenue. Prox 2017, 157 crores in revenue. 2019, 289 crores in revenue. 2020, 300 crores in revenue. 2022, 383 crores in revenue. And let's move forward, 553 in March 2023. And in fiscal year 2025, the latest financial year, we have 721 crores in revenue. So overall, let me push down here. Let me go. Yes. Overall, compounded sales growth, annualized sales growth numbers of 19% over the last 10 years. 16% sales growth over last 5 years, and of course, COVID being a big factor. 3 years, 23%, so the post-COVID rebound, and 19% sales growth for the past 12 months, or when the sales growth seen over the when compared to 12 months ago, basically. So TTM is trailing 12 months. Overall, very, very, very solid growth numbers. 19% annualized, 10 years, amazing. Okay, the kid's amazing, the company's amazing. Moving on, we have compounded profit growth, 36% over the last 10 years, 35% 5 years, 25%. The lowest number is 25% sales growth, and 30% sales growth over the last 12 months, trailing 12 months. Now we can see profit growth is way more than sales growth. What does this show? This shows the company has operating leverage. Its profits are growing way more than its sales, meaning when it first, let's say, establishes a shop and all that, we have a lot of fixed expenses. But as its sales are growing, the fixed expenses are again fixed. And the variable expenses, it is as sales grow, the expenses that may increase with sales. Let's say more raw material costs, more electricity costs, all that, more employee costs, like you're hiring more employees. That cost is not rising as fast. So this company has a lot of operating leverage, profits growing way faster than revenue. Then we have return on equity, 20%, very solid. 20%, nice, great. 23% over the last 3 years, 25% return on equity last 3 years, amazing. Last year, 21%, straight up solid. And if you want to come to operating margins, now you see this number, 205. This is operating profit. A percentage below it is the operating profit margin. You can see 28%, very solid. And before you see, there's a massive jump from 2018, 2021. Massive jump, massive jump. Before you can see, 10%, 11%, and 25% certainly. That is, from what I understand, and from what ChatGPT told me, it's just an accounting change. That's it. So, how accounting change? I can explain a bit. Okay, coming here, we have the interest. You see, interest? Interest is very low, and certainly it jumps up around the same time that operating profit margins increase rapidly. So just an accounting change. Basically, there was an IND IAS or some change in accounting standards in India, which basically said that this interest payment, right, needs to be counted as separate. What are these interest payments? From what I understand, lease payments. So Cantabil Retail has a lot of its stores and a lot of stuff it has taken on lease. And it has to, of course, pay interest like lease payments. The company has to make payments on the lease, on whatever it has leased. Maybe it could be new stores, maybe it could be some manufacturing facility. So all these things it has taken on lease, it has to pay all these leases. And earlier, these interest payments were not included. These lease payments were not included. From what I understand, I could be wrong. So please check up on that. But now, after this accounting change, these interest payments, these lease payments, payments on the lease, they are included as interest and they're not included in this like operating profit in these expenses region, right? These expenses, they're not included in expenses anymore. See, the blue one, expenses not included in expenses anymore, they're included in interest. So that's where operating margins rose. But after that increase, still a very solid 26% operating profit margin is still very, very solid. So we saw the overall return on equity 20%. Revenue growth and profit growth both were extremely solid. Have big numbers, 19% say revenue growth, 25% profit growth over the last 10 years. Very solid numbers. Now we're going to look at more information regarding this company. Okay, bit of spoilers there. This is the investor presentations report of Cantabil Retail, the latest one. And from here, we're going to get a lot more information about the company and more about the future of the company. What are its visions? What are its targets, its goals? Very interesting. So, first, we have operational updates. Here, we just get a lot of data about the company, regarding the company. So, first, total stores it has 605 stores. Total retail area, meaning a lot of the retail stores, all of its stores, how much space do they actually have? Total area, 8.06 lakh square feet. The latest as of Q1 fiscal 2026 as compared to 6.79 lakh square feet as compared to 12 months back. So big growth in retail area from 6.79 lakh square feet to 8.06 lakh square feet. Now PSF and SSG, don't worry, not big numbers. PSF, from what I understand, is sales per square foot. That's it. Per square foot of retail area, you can say. Sales per square foot. Higher this number, the better. You can say it's an profitability metric. How profitable is each square foot of all your retail stores? 624 rupees in SSG is one of the most important metrics in retail sector. SSG refers to store, no, sorry, same store sales growth. Yes, it's the same store sales growth. So how much sales growth is coming in your already existing stores, right? We have to see how much is all your like you have established a store. And let's say all your revenue growth is coming from opening new stores, but your already existing stores are not growing. That's a concern because let's say you don't have any more stores opening up. There's no sales growth, there's no profitability growth, revenue growth. So, same store sales growth, SSG, is very important. It shows that when you actually open up a store, then that store has future revenue possibilities. It has future growth profitabilities. And as no, sorry, as store numbers rise, and let's say SSG also rises, that contributes to a massive revenue growth. So, same store sales growth is very important. SSG stood at 11.3% for this quarter. This is a bit of an exception. Overall, it's not 11.3%, not the best same store sales growth, Cantabil. Like overall, from what I understand, it does not have the best SSG. Let's call it SSG. But this quarter, great, great. And overall, for this year, they're trying to maintain 5 to 6% same store sales growth. Moving on, ABV. ABV is the average bill value. Customer comes and buys something from Cantabil store. How much is the average purchase? How much is the average cost, the average bill that they're receiving? How much they're buying on average? 4,174 rupees average bill value. Big increase from like 12 months back of 3,768 rupees. ASP, average selling price of the product, 1,043 rupees. So 1,043 rupees. This is not very expensive, nor is it very cheap. We can say it's the mid premium, yeah, mid region. I believe mid region is, yeah, that's a good assessment, I guess. Mid in terms of pricing, mid market region. Then this company has a pan India presence. Now this must be stores by states. So its retail stores, Cantabil's retail stores are in which states? Jammu Kashmir 18, okay, Punjab 48, Haryana 56, Rajasthan 87, Gujarat 42, Madhya Pradesh 42, a lot on the west coast, western regions, the big states, of course. Maharashtra 66, what else? Chhattisgarh 12, Telangana 4, Jharkhand 13, West Bengal 6, okay, eastern side a little less, understandable. That's the population there. Bihar 15, Uttar Pradesh 100, Uttarakhand 23, and Delhi 58. So overall speaking, one sixth of all stores, around one sixth of all stores are in Uttar Pradesh. But geographically speaking, at least the store wise, geographically it's pretty diversified. It's present all throughout India, but there are many states with a lot of numbers like Delhi 58, or Haryana 56, Rajasthan 87, Gujarat 42. So a lot of geographical diversification, which is always a good thing to see. Moving on, we have more numbers. I think here there's only one statistic to see. This. Now they claim this. I don't know how to fact check this, but I guess I believe them. 50% repeat customers year on year. Great, that's great. 50% of customers are coming again, year on year. That's a very good statistic. Moving on, we have more data. All right. So this is the financial performance from 2021. Revenue from operations, massive growth, 721 crores this latest year, 616 crores last year. The gross margins, yeah, this is the gross profit and the gross margins. Gross profit, 423 crores, 346 last year. The gross margin standing at a very high 59%. And it's increasing. See, it's increasing. 56 crores, sorry, 56% in 2023, 56% in 2024, a nice rise from 2021, 51%. So gross margins are increasing. Here we have profit after tax and profit after tax percentage, 75 crores in profit after tax, fiscal year 2025. Big increase from 2022, where we had only 38 crores in profit after tax, and the profit after tax margin, PAT margin, 10%. Pretty consistent. Nice rise from 2021, which must be the COVID. Due to COVID, it has gone so low. But 10%, okay. Then we have EBITDA percentage, 28%, high 20s, very nice, 205 crores EBITDA this year, 163, 165 crores. Nice numbers, pretty nice numbers. Moving on, we have the balance sheet. Now, in this balance sheet, I guess there's only one thing to really show, which is this current assets. Current assets are assets which can be converted into cash within 1 year. It represents liquidity of a company in one way, or a massive part of a company's liquidity. How liquid the company is, how much investment, how much cash it has. So 337.5 crores. Yeah, these numbers are in crores this year. Now, the other thing is current liabilities. How much does the company owe in the next 12 months? How much it has to pay back to, let's say, its borrowers, not the borrowers, its lenders. How much money it owes to its suppliers and all that. 159 crores. So current assets, like 337, current liabilities, 159. So current assets minus current liabilities is more than, and this is known as the current ratio. Current assets minus, so divided. Current assets divided by current liabilities is known as current ratio. And the higher this ratio, the more it shows the financial health of a company. The higher this ratio, the more balance sheet wise is the company health. More healthy is the company balance sheet wise. That is what I want to say. More the difference between current assets and current liabilities. Higher the current assets is compared to current liabilities, it is better. And higher this ratio, current assets divided by current liabilities, known as the current ratio, it is a better for a company. More than one is good, less than one depends on the industry if it's bad or not. Because there are industries in which current liabilities are naturally more. Moving on, we have few more things to see. Okay. Return equity we already saw. 20%, 35%. The way they calculated this, all right, no, return equity is fine. 35% would be the COVID boom, rebound. 20% is still solid. Overall speaking, 20% is still solid. Now, return capital employed. These guys have a different way, I believe, calculating return capital employed. They claim it's 36% right now, 57% in fiscal 2023. Okay, they have their own method. They mention it right here. The way they calculate ROCE is the numerator is EBIT, which is earnings before interest and taxes, and the denominator is the average shareholders fund plus total debt minus non-current investments. So, all right, debt to equity ratio 0.03, no, almost zero. Debt compared to equity, very, very impressive. It seems there is negligible debt or very little debt compared to the total equity. Lower this number, better. So balance sheet wise, the company seems to be very healthy. Return assets 8%, nice. 8%, I don't know the average, but okay. Overall, we see stable we can say. Now, number of stores and retail space. Here it says Coco and Fofo. These are all its stores. Coco stores are those stores which are company owned, operated by the company. Company owned, company operated. COCO. FOFO is franchisee owned, franchisee operated. Franchises. Basically, Cantabil has the clothing, Cantabil has the brand. So, if there's a person, the franchisee, the franchisee, Let's say a person who owns some land, they own a store. Cantabil, they can ask Cantabil that they can sell Cantabil clothes in their store, and they can operate the store. They can manage the day-to-day workings of the store, and they will pay Cantabil Retail a fee, a franchisee fee. And I believe Cantabil in that case will be the franchisor. They will give the clothes to this store owner, whoever person is, and the store owner will pay them a license fee, a franchisee fee. So a lot of stable, high margin revenue can come from here. And COCO, company owned, company operated. Company owns the store, company operates the store. So COCO stores have increased from 231 4 years ago to 463. Straight up doubled. More than, is that doubled? Is that doubled? Yeah, yeah, yeah. Doubled, straight up doubled. Uh, four stores increased from 89 to 136. All right, 89 and 136, which refers to an annualized growth rate of 11%. 11% growth in FOFO stores over the last 4 years. Very nice. The total retail space has grown from 3.5 lakhs of square feet to now 7.8 lakhs of square foot. So big growth in store numbers and a big growth in retail space, which does explain to some extent the massive revenue growth we saw earlier. So sales per square foot, not the best, 903 rupees in 2023, and has taken a bit of a hit, 784 rupees. Could be because of the massive expansion in the number of stores and all that. That the We can see like 318 stores in 2023. Big jump, 402 stores, 24. Maybe the company is just focusing more on growth. Again, the decision is on you. Sales per square foot, bit of a decline. Working capital days, how much time it takes for a company to convert its working capital into revenue. Lower this number, the better. Currently, it seems to be stable at 114 days. Then we have inventory days. How much time does it take for a company to convert its inventory into revenue? Lower this number, the better. 141, this also seems pretty stable. Moving on, store categories. So the different colors is for the different years. Let's look at the years, I guess. Lightest color is the latest year, fiscal year 2025. 250 of its stores comes from men's. It's for men. And sorry, 187 of its stores are for men and women both. Ladies and kids only 41. Ladies store only 5. And family store 116. So men dominated, unisex dominated, and family dominated. Okay, revenue category. Menswear contributed 81% of revenue, and it's declining 86% 2 years back, fiscal 2023, and fiscal year 2025, 81% of revenue. Women's wear seems to be rising, now 11% of revenue. Accessories 5%, kids wear 3%. So currently, even still currently, dominated by menswear. Revenue that is. Revenue store wise, okay. COCO stores increasing in revenue, okay. Revenue contribution that is. And 22% of revenue comes from FOFO stores, which is franchisee owned, franchisee operated, and revenue by geography. Okay, North 58%, 58% of revenue comes from North India. 30% revenue comes from, where is this, West. 5% from East, 6% Central. So Northern Western dominated. All right, all right. I think we have come to the last of the presentation, but there's just few more things to show. Now, what exactly was it that I had to show? Yes, the vision, yes. Vision 2027. What are their plans till, yeah, next year, I guess. A couple, next year, based, no, few more, 2 more years. Yes, Vision 2027. Vision 2027. All right. Now we saw revenue. What was the revenue again? Revenue was 721 crores. Okay. So in the next 2 years, they wish to reach 1,000 crores in revenue. Okay, so their vision is to reach 1,000 crores in revenue. This Vision 2027. They want to increase their store network to 725 stores from existing 605 stores. And they're increasing focus on exclusive women and kid wear stores. Okay, 725 stores is their target next 2 years. They're increasing their geographical presence, all right, identifying new markets in India, expanding to 325 cities from the existing 295 cities, right? Focusing more on same store sales growth, SSG, yeah, achieving higher single digit same store sales growth, better inventory rotation. Inventory rotation can include basically there are some stores which sell more clothes faster pace, some stores which sell clothes at a lower pace. So if some new clothing has come out, it's selling very well. At one store it's selling slow, one store very fast. Then inventory or the clothing can be shifted from the slow growing stores or slow selling stores to the fast selling stores. So invent better inventory rotation and then improving efficiency. They're reducing costs and achieving efficiencies in order to remain competitive and maintaining healthy EBITDA margin of 28 to 30%. So the vision is growing from 720 crores in revenue to 1,000 crores in revenue in the next 2 years. EBITDA margins 20-30% stable, improving stores from like 700 and what was that 725 stores from 605. More focus on kids wear. So this company, Cantabil Retail, in a summary, is a very fast-growing company. It's a retail company selling parent, ready-made garments, dominated by North, or I think 50% of revenue comes from North India, but still stores across India. 30% revenue comes from the western region of India. Uh, focus, not focus, but majority of revenue comes from menswear and a bit from family wear, but majority of revenue comes from basically menswear. So menswear currently focus more on kids and ladies wear revenue, expanding rapidly. And one last thing we can show, right, is cash flows. Yes, cash flows. Cash flows is a very important metric for investment. So the real cash being generated from, well, the operations and all that, generated by the business. So cash flows, 6 crores in cash flows from operating activities 2014, 10 crores 2017, 24 crores 2019, 62 crores 2020, 67 crores 2021, and 133 crores cash flow from operations 2024 and 150 crores in cash flow from operations 2023. You can see there's a massive and consistent increase in cash flow from operations. Bigger this number, the better. So this is also a company who's growing its cash flow from operating activities extremely rapidly. So that was it. Hope you liked the video and hope you got some information that you liked from this video. Have a nice day.